selling stock. In an IPO, in an initial public offering, we can sell our stock for whatever we believe the public was willing to pay for it. Usually in an IPO, we go to an underwriter and we negotiate with the underwriter a price that they will sell the stock initially to the public for. And then the underwriter publishes in the newspaper, hey, we're going to sell the stock, this is a brand new company, it's an IPO, and this is the price. And then prospective stockholders line up, and when the stock goes public, they buy the stock at that price. So let's look at some different instances about that initial public offering price. The first one says that we have $25 par on our stock, and par value is what the stock certificate has printed on it. In other words, it's the underlying value of the stock. Par value doesn't mean as much now as it once did. Corporations came into existence around the time of Charles Dickens, and they really needed resources to expand because of the Industrial Revolution. And so they decided to come up with this corporate form of business and sell stock. And so at that time, if you gave $25, you wanted that stock certificate to have a value on it, and that was called the par value. So in the first instance, we're going to sell our stock for its par value, $25. And we're looking at exercise 11 in this problem. And in exercise 11, we are going to sell 5,000 shares to the public for $25 a piece. Well, if that's the case, we're going to debit cash for 5,000 shares times $25 a piece. So the total cash that I'm going to receive is $125,000. So that's the cash. I am going to print up and issue out authorized, issued, and outstanding common stock for 5,000 shares at its $25 par value. In other words, $125,000. So that's the first instance. The second instance says, well, what if instead we sell the stock for $25, but its par value, what's printed on the certificate, is only $10? How would that change it? Well, we debit cash, because are we still getting 5,000 shares times $25? So we were receiving $125,000 in cash for selling our stock, but we're going to credit common stock at its par value, $10. So 5,000 shares times $10 is only $5,000. Well, that doesn't balance, does it? Oh, but wait, what color were we going to think about if things didn't balance? Pink. So we've got a credit paid in capital for the difference. So the fabulous plug is 20,000. And remember, we call it pink because it's P-N-C, pink. Now, the third instance says, what if the stock has nothing printed on it? In other words, it has no par value. That's number 3. Well, if something has no par value, you record it for whatever you received. So it would be the same as 1. So in other words, if there's no par value, debit cash for $125,000, credit common stock for $125,000. No par. The final one says we're no par, but we have a stated value of $1. We still sell it for $25 each, but no par, but a stated value. Now, what's a stated value? A stated value says that the board of directors votes on a value for the stock. So all those in favor of the stock being worth $1, raise your hand. So they all voted that it's worth $1. So here's the entry. We're going to debit cash again for the 5,000 shares times the $25. So I get a total of $125. I'm going to credit common stock for its stated value of $1. So 5,000 shares times $1 is 5,000. And this entry doesn't balance, does it? Paid in capital. So credit paid in capital for the difference of $120,000. And that's how you sell stock.